Hello, guys, and welcome to your market report for this Tuesday, October 2nd, 2018. I'm going to surprise you guys a little bit this morning, and I'm going to tell you why. Well, let's first open the charts right here, and let's go to the silver price. And why this is going to surprise you is right now, as I'm recording, silver's up 13 cents. And we've been used to it going up like this, 13, 15 cents, 20 cents. And some people out there say, oh, silver's going to go to the moon and everything else, right? And then it falls back down again because they suppress the price. Guess what, guys? I don't think it's going to happen this time. I think we're going to get a pop in the price of silver in the next very short period of time. Silver's going to pop, and gold's going to pop too, and I'm going to tell you why right now, coming right up on this episode. Stay tuned. Welcome back, guys. Now listen, this is why I think the silver price is going to pop. For years now, Federal Reserve has done everything that they can possibly do to support the dollar, a weakening dollar. But now that they've embarked on this program of quantitative tightening, everything's changed. The dollar's getting too strong. And it's pushing the world toward a crisis, toward a emerging market crisis that could tear down the entire system, and they realize this. So behind the scenes, I think this is what these trade tariffs are all about. All about creating consumer inflation. Okay? Now with that in mind, I want you guys to remember that the forces and the powers that be are working in conjunction with the Fed to try to create inflation right now. Desperately trying to weaken the dollar. The Fed's trying to weaken the dollar. But at the same time, the monetary policy that they're following with the quantitative tightening and raising interest rates is strengthening the dollar. But they want to continue. They have to continue with this policy or the dollar will die. I know all of this is hard to follow. It's hard to understand. But they're trying to weaken the dollar because the dollar is going to start heating up and becoming stronger. Now, silver right now, we've gained 14 cents on the day. And most times I say when we gain 14 cents, okay, we're getting ready to be smashed again. And the price is getting ready to knock down. I don't think so, not this time. I think this time it's going to pierce through 14, 15, 16, 17, 18, 19, 20. I think we're on our way to $22 on silver. I'm making this call, going out on a limb, guys. I'm going out on a limb. I think we're going to 22 bucks. And I'll tell you the reason why. I've just saw the oil price shoot up. These guys are manipulating the oil price, and they're shooting it upwards. But I think silver's going to follow the same, and gold's going to follow the same percentage upwards. And this is an effort, I believe, by the powers that be that were suppressing the price of silver a couple years ago to support the dollar. Like last year or whatever, they were suppressing the price of silver. They were suppressing the price of oil. Now they've changed direction. Silver first, oil first. They've done oil first. Oil's moving first. It's a first mover right now. Okay? Silver and gold's going to follow. And the reason is all about because the dollar is popping up in strength. This is to weaken the dollar back down so that they can continue with their process of quantitative tightening without the economy collapsing. And they have to continue with the quantitative tightening or the economy will collapse. So basically what I'm saying is they're caught in what's called a catch-22 situation. where they have to continue with quantitative tightening and raising interest rates to support the dollar. But at the same time, if the dollar gets too strong, they're going to have a huge crisis that's going to destroy the system as well. So they have to now reverse gears on the price suppression on gold and silver, but not too much. Not too much, mind you. They have to reverse gears on the price suppression of gold and silver, and they also have to reverse gears now on the price suppression of oil. So they have to let oil go up, and they've got to let gold and silver go up, the commodities go up, to take the pressure off and bring the pressure down on the dollar so that the dollar will come down some. And that's what I think is going on. And so I think that this is the whole reason behind these trade tariffs. I think Trump is working in conjunction, working with the Fed. They're all working in together to try to hold things together to keep this system from collapsing. And I think now's the time for gold and silver. I think we're going to see its move. I'm on the front edge of this thing. I can see it. I think they're going to release it now. I think now is the time that they're going to release it, but only so much. They're going to constrain it, I think, around when it gets around 20 or 22, because it'll destroy the system too if it goes too high too fast. Then they have to support the dollar if these commodities goes too high. If oil goes over 100, they got problems, and if silver goes over 22, and if gold goes over, say, 1,400, they got problems again. So they got a narrow band here, and I think they're gonna try to let it go up, gold go up to around 1,400 right now, and silver will probably pop up to around 22, and then we're looking at oil probably going up to maybe 90. This is what they're gonna have. This is the way I see it. That this is what they're gonna have to do in order to keep the dollar from going too high too fast, to create this emerging market crisis. If this is making sense to you guys, because I'm going out on a little bit of a limb, because I see oil popping first, because that's the strongest one. The oil has the strongest relationship to the dollar, because we're in an oil-based economy, not a gold. Gold, people, all these guys out there, they always connect gold to the dollar and everything, but no, oil. The dollar is oil, so it's done oil first. Oil's popping first. I mean, it's really popping. Watch gold and silver. Watch gold and silver, guys. That's all I got to say. Is I got a tendency to think that this is the time gold and silver is going to break free. Like I've seen these little pops before, and I'm like, oh, it's nothing. They're going to knock it back down again. I don't think so. Not this time. This time's different. This time's different because the dollar's popping. So let's get to the charts. Let's forget about what I just said and just watch and see if it happens, of course. If it doesn't happen, I mean, maybe I'm wrong. I could be wrong. But let's get to the charts. Let's take a look at the price of Bitcoin today. Bitcoin is 65.43 today, and we've had 4 days now where Bitcoin could not break through and go to the upside. 4 days. And if it keeps lingering down here around 6,500, it could actually break to the downside. I mean, this is the thing. The longer it can't break through these levels and move to the upside, the more likely it is to move to the downside. And so taking a look at cryptocurrency market capitalizations today. We're looking at a market cap of 221 billion. We're looking at 51.4% Bitcoin dominance and a mixed bag. An awful lot of coins are in the red today. XRP is riding high. Anyway, let's take a look at the silver price. Oh, we already looked at that, but we're up. We're up and we're continuing to move up, and I think that it's going to continue on its merry way. Anyway, it's $14.62 for silver. Let's just take a look at gold on the live chart. I know I normally don't do gold, but yeah, see, there's a move in gold today. It's heading up toward $1,200. It's moved up $10.40, and I think this time I don't think it's going to get smacked back down again. I think this is it. This is the move. I'm calling it. I think this is the move because I think they have to do it in order to weaken the price of the dollar because of their monetary policy. Basically put, that's what I think is going on. Dow Jones Industrial Average today. Well, yesterday we were up 192 points. We'll have to wait and see what happens today. But this market, you know, is way oversold. It's a bubble. The stock market is in a hyper bubble. It's not just a regular bubble, it's a hyper bubble. I've called it before. I've said that when the bond rate hits 3.25 on the 10-year, that's when this market's going to get in trouble. And I don't believe this market's going to get in trouble until the bonds get higher than they are now. I think as long as the bonds stay down around where they're at right now and interest rates stay down, I don't think this market's going to get in trouble until at least one more interest rate hike by the Fed. Next interest rate hike by the Fed's going to do it. Say goodbye to this market. But so this is a very risky venture, to tell you the truth, in the market right now. But there's no place else for the money to go, for crying out loud, except into equities. Where else are they going to go? They've been trapped. And they can't buy gold and silver bars with the big money. You know, they got bonds. They can choose bonds or equities. Bonds has been in a 30-year bull market, for crying out loud. I mean, like, that's not getting ready to pop, you know? Okay, so let's take a look here at Sweet Light crude oil. And you can see the crude oil price is popping. It's popped first. It's going up. 75.39 for Sweet Light crude. I mean, that means that the other oil is even higher. It's probably getting up near about $80, you know, and surging higher. And so oil prices are gone on their way up. This is bearish for the dollar, you know, higher oil prices, because there's an inverse relationship between the dollar and oil. Oil goes up, the dollar goes down. Because basically it means you can buy less oil with the dollar, and that's why they call it the petrodollar, is because oil is what the whole economy is based on. It's not based on gold, it's not based on silver, it's based on oil. That's an oil-based economy, and that's why it's called the petrodollar. So they need to knock the wind out of the dollar sails. This is what the Fed needs to do in order to continue with their monetary policy of quantitative tightening, because they're withdrawing liquidity, which strengthens the dollar, and they want to continue with that. They have to continue with that process. They have to continue raising interest rates, or the dollar will die suddenly, and they know this. So in order to keep the dollar alive, they have to knock the dollar down. I don't know if that really makes any sense. It doesn't really make any sense, the fact that they have to try to kill the dollar in order to keep the dollar alive. It's a real weird world, the way things actually work, you know. Bonds and rates today. What we're looking at here is a mixed bag. We're looking at a flattening yield curve. It's continuing. Whenever you see the lower end here, right, the rates going up and the higher end falling, you're seeing flattening, you know. Now, this could reverse direction later today, and I'm expecting the yield curve not to flatten, to tell you the truth. I'm expecting the higher end of the yield curve to pop higher, high enough where even though they're raising interest rates, that it'll keep ahead of the interest rate hikes. And this is what I've expected all along. This is why I haven't been one of these guys out there preaching flat yield curve, or worrying about the flat yield curve. You notice how for the last 6 months or so, these guys have, oh, the yield curve's going to flatten. Oh, the yield curve's going to flatten. And I haven't been going there. I've been haven't been saying anything about that much. even though the yield curve has been flattening somewhat because they're raising the lower end of the curve, and this higher end of the yield curve hasn't been moving much. That's because they've been buying the hell out of it. There's no place else for the money to go, you know? And so the excess liquidity in the system is drying up fast, but that's what's going to create the effect of making this higher end of the yield curve pop, and it's going to keep ahead of the low end of the yield curve, even though they're raising rates. That's what's going to happen. Okay, now let's look at the U.S. dollar index. She's riding high, boys. See, and this is the reason why. Because she's riding high like this. If this was down to 93 or 92, you probably wouldn't see them let silver pop. But they're worried right now. When it gets up toward 96, they're worried. They'd even be more worried if it was 96 or 97, right? And this is the reason why I think silver's going to pop. In the short term, I think they're probably going to let it go up to about 17, back up to 17 or 18 in the short term. But in the longer term, as they have the next interest rate hike, you're going to see silver go up to 22. You know, and so we're going to start to see some movement on the price of silver upwards. This is my prediction, and it's all based on what's happening with the Fed and this dollar right here. But listen, I'll tell you guys, this is not financial advice. I'm not telling you to sell your house and buy silver. Although you probably would do all right because silver right now is down on mining production cost. You know what I mean? Basically. And I mean, I've never seen it in comparison to the cost of living. The silver price right now has never been cheaper if you compare it to the cost of living, you know. So listen, this has been my market report for this morning. Thank you guys for listening. I really appreciate each and every one of you guys tuning into my report. And this whole thing's going to turn around pretty soon. The goose, our goose is cooked, honest to God. You know, in the next few months, we're just going to descend into something like really bad. Anyway, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.